Shalom, I'm Rabbi Isaac Rothman, and today I'm going to show you exactly what's happening to your money right now. Why 2026 presents challenges that most financial advisors aren't discussing, and the only approach that will actually protect and grow your wealth through what's coming. But I need to warn you about something first. The solution I'm going to share isn't what you expect. It's not complicated, it's not trendy, it's not exciting, it's not some secret investment that nobody knows about. It's boring, it's old, it's the same approach that has protected wealth through every crisis in modern history. I've been managing money for over 40 years. I've seen 5 major market crashes. I've watched currencies collapse. I've seen inflation destroy the savings of entire generations, and I've seen families preserve and grow their wealth through all of it. The difference between those who survived and those who didn't wasn't intelligence. It wasn't luck. It was understanding what I'm about to teach you. Let me start by showing you what's actually happening to your money right now, because most people have no idea how much they're losing while doing absolutely nothing wrong. The average American has approximately $65,000 in savings. The average household in Britain has about £17,000 set aside. Most of this money sits in traditional savings accounts, earning somewhere between 4 and 5% interest. That sounds reasonable, responsible even. Your parents would be proud until you understand what's really going on. Inflation over the past 4 years has cumulatively exceeded 20% in both America and Britain. Let me translate that into real numbers. If you had $100,000 in 2020, the purchasing power of that money has dropped to approximately $80,000 in real terms. You didn't spend it. You didn't invest it badly. You didn't make any mistakes. You just let it sit there, being responsible, doing what you were told, and you lost $20,000. Nobody sent you a bill. Nobody took money from your account. But it's gone. The things that cost $80,000 in 2020 now cost $100,000. Your money didn't move. The world moved around it. Here's what concerns me about 2026, and I don't say this to scare you. I say this because you need to understand the environment your money exists in. Central banks are caught in a trap. They raised interest rates aggressively to fight inflation. It worked partially, but now economies are slowing. Growth is weakening. Unemployment is rising. The pressure to cut rates is building. When rates drop, the interest your savings account earns will collapse. You'll go from earning 4 or 5% to earning 2 or 3%. But inflation doesn't disappear overnight. You'll be earning 2% while prices keep rising at 4 or 5%. Your money will be losing purchasing power even faster than it is now. But that's only the first problem. The second one is something almost nobody discusses, and it's the one that keeps me up at night. Currency devaluation is accelerating globally. The U.S. dollar has lost over 96% of its purchasing power since the Federal Reserve was created in 1913. The British pound has followed a similar trajectory. This isn't conspiracy. This isn't doom and gloom. This is mathematics. This is history. This is what happens to every fiat currency eventually. Governments around the world have taken on unprecedented levels of debt. U.S. national debt has exceeded $34 trillion. UK government debt has surpassed £2.6 trillion. Debt to GDP ratios in most developed nations are at levels that would have been unthinkable a generation ago. When governments have too much debt, history shows they rarely pay it back honestly. Instead, they inflate their way out. They allow the currency to lose value so that the debt becomes easier to manage. They print money. They expand the money supply. They do whatever it takes to avoid defaulting. Your savings are denominated in those currencies. Every dollar or pound you hold represents a claim on purchasing power. When governments devalue currencies to manage their debt burdens, your savings pay the price. My grandfather understood this better than anyone. He lived through currency collapse twice, once in Austria before the war, once in Germany, where family members watched their life savings become worthless in months. He used to tell me, "Isaac, governments always choose inflation over default. Always, because default is visible. People riot, politicians lose power, but inflation is invisible. It happens slowly. People blame businesses for raising prices. They blame workers for demanding higher wages. They blame everyone except the government that's stealing from them." He was right. I've watched this happen repeatedly throughout my career. The people who suffered most were always the savers, the responsible ones, the people who did everything right according to conventional wisdom. They held cash. They trusted the system, and they watched their purchasing power evaporate over decades. But 2026 brings additional challenges that make this even more dangerous. The global financial system is fragmenting in ways we haven't seen since World War II. Geopolitical tensions between major economic powers are creating uncertainty that ripples through every market. Supply chains that seemed permanent are being restructured. Trading relationships that lasted decades are being questioned. Currency wars are no longer theoretical. They're happening right now. Countries are actively trying to weaken their currencies to gain competitive advantages. When everyone races to devalue, the only losers are people holding those currencies. Keeping your money in a savings account and hoping for the best isn't a strategy. It's a slow-motion disaster waiting to happen. But here's where people make their biggest mistake. And this mistake has cost more wealth than any market crash in history. When people get worried about their savings, they panic. They pull money out of stable investments and chase whatever seems hot at the moment. They buy crypto at the peak. They pile into meme stocks. They fall for promises of incredible returns with no risk. They become exactly the kind of emotional investor that loses money in every market condition. I've seen this pattern destroy more wealth than inflation ever has. The person who loses 20% to inflation over a decade is still better off than the person who loses 50% in 6 months, chasing the next big thing. Panic is never the answer. Fear is never a strategy. The Talmud teaches, "Who is mighty? He who conquers his impulse." Most people hear that and think it's about anger or desire. It's not. It's about fear. The person who conquers their fear-driven impulses is the one who builds wealth. The person who acts on panic destroys wealth. The solution to protecting your wealth in 2026 isn't about finding some secret investment or timing the market perfectly. It's about understanding timeless principles that have protected wealth through every crisis in modern history. Principles that my grandfather used, that I've used, that every wealthy family I've ever worked with uses. But first, you need to understand why most advice you're hearing right now is wrong. The financial industry profits when you move money around. When you're scared, they sell you products. When you're greedy, they sell you products. When you're confused, they sell you products. They don't make money when you sit still. They make money when you trade. Most financial media exists to generate clicks and views, not to actually help you build wealth. That's why you hear contradictory advice constantly. One expert says markets are about to crash. Another says we're entering a massive bull run. One recommends gold. Another says gold is useless. One pushes real estate. Another warns of a housing collapse. This noise serves a purpose. It keeps you engaged. It keeps you confused. It keeps you dependent on their next piece of content. It keeps you trading, which generates commissions. It keeps you anxious, which makes you susceptible to buying whatever solution they're selling. I've watched this cycle repeat for decades. The actors change. The products change. The underlying manipulation remains exactly the same. So let me cut through all of it and tell you what actually protects wealth, what has always protected wealth, what will continue to protect wealth through whatever 2026 brings. The only way to truly protect your money isn't a single action. It's a system, a framework, a set of principles applied consistently over time. I'm going to share 4 essential components that must work together. Miss any one of them and the others become less effective. I implement all 4 and you'll be better protected than 95% of people heading into 2026. Component 1, the gap. You must spend less than you earn by a significant margin. This sounds almost insultingly simple. You've heard it 1,000 times. But let me show you why it's the foundation everything else depends on, and why almost nobody actually does it. The average American household earning $70,000 annually saves approximately 3 to 4% of their income. That's about $2,000 a year. After accounting for inflation, their savings are essentially flat or negative in real terms. They're on a treadmill going nowhere, working hard, feeling responsible, getting poorer every year. Wealthy households operate completely differently. They maintain savings rates of 20, 30, even 50% of their income, regardless of how much they earn. The gap between income and spending isn't something they think about occasionally. It's engineered into their lifestyle permanently. My grandfather used to say, "A rich man is not one who earns much. A rich man is one who keeps much." He lived on half of what he earned his entire life, not because he couldn't afford more, because he understood that the gap is everything. In 2026, this gap becomes even more critical. When economic uncertainty rises, job security decreases, income streams become less reliable. The people with large gaps between income and spending have options. They can absorb income disruptions. They can take advantage of opportunities that appear during downturns. They have time to make smart decisions instead of desperate ones. The people living paycheck to paycheck have no margin for error. One job loss, one medical emergency, one unexpected expense, and they're in crisis. They become forced sellers at the worst possible time. They take jobs they shouldn't take. They make decisions from fear instead of strategy. Let me tell you about Robert. Robert came to me 15 years ago. He was earning $200,000 a year as a corporate executive, and he was saving almost nothing. Big house, nice cars, private school for the kids, country club membership, living exactly the lifestyle his income supposedly afforded. I told him he was one bad quarter away from financial disaster. He laughed, said his job was secure, said his company was stable, said I was being paranoid. 2 years later, his company restructured. He was out. Took him 8 months to find a comparable position, but by then the damage was done. He'd burned through his small savings, taken on credit card debt, had to pull his kids from private school, sold one of the cars at a loss. If he'd maintained a 30% gap between income and spending, he would have had 18 months of expenses saved. He could have waited for the right opportunity instead of grabbing the first offer. He could have negotiated from strength instead of desperation. Compare that to Elizabeth. Elizabeth earned $80,000 a year, less than half of Robert, but she saved $20,000 a year, lived on $60,000. When her company laid off 30% of the staff during a downturn, she was in the group, but she had 2 years of expenses saved. She spent 3 months exploring opportunities, took a course, updated her skills, eventually took a position that paid more than her previous job with better growth potential. Same crisis, same job loss, completely different outcomes. The difference wasn't income, it was the gap. Before you do anything else, ruthlessly examine your spending. Cut everything that doesn't genuinely improve your life. Every dollar or pound you free up becomes fuel for protection and growth. Component 2, ownership. You must own assets that produce real returns above inflation. Cash in a savings account is not an asset. It's a temporary parking spot that's leaking value every day. Every year you hold cash, you're paying an invisible tax to inflation. Every decade, you're losing a significant portion of your purchasing power. Real assets are ownership stakes in productive enterprises. When you own shares in a company, you own a piece of a business with employees working every day to create value. You own equipment, inventory, intellectual property, customer relationships, real things that exist in the world. These real assets tend to hold their value and grow even when currencies decline. Consider this mathematics. If the dollar loses half its value over the next 20 years, which is entirely possible based on historical trends, the price of everything doubles. A company that sold products for $100 now sells them for $200. Its revenues double in nominal terms. Its profits likely double. Its stock price adjusts accordingly. Your shares, which represent ownership of real productive assets, maintain their purchasing power. Meanwhile, dollars sitting in a savings account simply buy half as much. This is why I've spent my entire career buying ownership stakes in great businesses, not because I predicted any particular crisis, not because I'm smarter than the market, because ownership of productive assets is the most reliable long-term store of value humanity has ever created. Proverbs teaches, "A good man leaves an inheritance to his children's children." Notice it doesn't say a good man leaves cash. Cash is temporary. It loses value. It can be inflated away by governments you'll never meet making decisions you'll never see. A good man leaves ownership, shares in productive enterprises that will still be creating value when his grandchildren are grown. For most people, the simplest way to own productive assets is through low-cost index funds that track broad market indices. You don't need to pick individual stocks. You don't need to follow markets obsessively. You don't need to be smart. You simply need to own pieces of many businesses and hold them through all conditions. The S&P 500, a total stock market fund, a global equity fund. Simple, boring, effective. When I first started on Wall Street, I thought successful investing was about being clever, finding the hidden gem, timing the market perfectly. After 40 years, I've learned the truth. Successful investing is about being consistent, owning productive assets, not selling during panics, not buying during manias, just holding. The clever investors usually underperform the boring ones because cleverness leads to trading. Trading leads to costs. Costs eat returns. Boring wins. Component 3. Liquidity. You must maintain strategic liquidity for opportunities and emergencies. This might seem to contradict what I just said. I told you cash loses value to inflation. Now I'm telling you to keep cash. Both are true. And understanding why requires understanding what cash actually is. Cash is not an investment. Cash is insurance. Cash is optionality. Cash is the ability to act when others cannot. In every market downturn I've witnessed, the best buying opportunities appeared. Great businesses went on sale. Assets that were expensive became affordable. But you could only take advantage if you had available capital. In 2008, I watched people sell their stocks at the bottom because they had no cash reserves and needed liquidity. Then I watched other people buy those same stocks at massive discounts because they had cash waiting. The people who sold retired poor. The people who bought retired wealthy. The difference wasn't intelligence, it was liquidity. In every personal crisis, cash provides survival time. Job losses, health emergencies, unexpected obligations, family needs. These require immediate liquidity that investment accounts can't always provide quickly. And selling investments during a downturn to cover emergencies is the most expensive money you'll ever spend. I recommend maintaining at least 6 months of essential expenses in highly liquid form, not invested, not tied up in assets that could take months to sell. Available immediately, in a savings account or money market fund where you can access it within days. This isn't money you're investing. It's insurance. It's buying power for emergencies and opportunities. It's what allows you to stay calm when everyone else is panicking. My grandfather called this the fortress. Money that protects everything else. Money that lets you sleep at night. Money that turns crises into opportunities. Yes, this cash will lose some purchasing power to inflation. That's the cost of security and optionality. It's worth paying. Think of it as an insurance premium. You pay it, hoping you'll never need it. But when you need it, it's worth everything. Let me tell you about Thomas. Thomas had a good portfolio, well diversified, low costs, all the right things, but he had almost no cash reserves. Everything was invested. Then 2020 happened. His company shut down temporarily. His income dropped to zero for 3 months. He had bills to pay, kids to feed, mortgage due. He had to sell stocks in March of 2020. At the bottom, locked in 40% losses on the shares he sold. 3 months later, those shares had recovered most of their value. But Thomas didn't own them anymore. If he'd maintained 6 months of expenses in cash, he could have waited. He would have recovered with the market. Instead, he sold low and bought nothing. That's the cost of not having liquidity. It's not abstract, it's real, it's permanent, and it happens to smart people every single downturn. Component 4. Automation. You must automate everything and remove yourself from the decision-making process. This is the component that determines whether the other 3 actually get implemented, because human beings are terrible at making consistent financial decisions. We're emotional. We're easily influenced. We get tired and distracted. We intend to do the right thing and then don't follow through. Every study of investor behavior shows the same pattern. People buy high and sell low. They chase performance. They panic during downturns. They get greedy during bull runs. They underperform the very investments they hold because they can't sit still. The average equity fund has returned about 10% annually over the past several decades. The average investor in those funds has earned about 4%. Same funds, different returns. Why? Because people buy after the fund has gone up, feeling confident, feeling like now is safe. Then they sell after it goes down, feeling scared, feeling like they need to protect what's left. They systematically buy high and sell low, not because they're stupid, because they're human. The solution is automation. Set up automatic transfers from your checking account to your investment accounts on the day after you receive income. Choose your investment allocations once, based on principles, not predictions, and then automate the purchases. Create systems that execute your plan, regardless of how you feel on any given day. The wealthy don't have superhuman discipline. They have systems that make discipline unnecessary. The money moves before they can talk themselves out of it. The investments happen before emotions can interfere. The plan executes automatically, month after month, year after year, decade after decade. When I first started advising wealthy families, I thought they succeeded because they were smarter about investing. They weren't. Most of them knew less about markets than I did. They succeeded because they had systems, trusts, automatic transfers, rules they'd set decades ago and never violated. One family I worked with had a simple rule established by the grandfather 50 years ago. 20% of all income goes to investments before anything else. Not after bills, not after spending, before. Automatically. 3 generations later, that family is wealthy beyond anything the grandfather could have imagined, not because they picked better stocks, because they automated a principle and never interfered with it. The day you set up automation is the day you start building wealth for real. Everything before that is just intention. Now, I know what you're thinking. You're thinking, Rabbi, I understand these principles, but 2026 is different. The economy is different. The risks are different. Shouldn't I be doing something special? Here's my answer. I've heard this objection in 1987, in 2000, in 2008, in 2020. Every single time, people told me that this time was different, that the old rules didn't apply, that special circumstances required special action. Every single time, the old rules worked. Spend less than you earn, own productive assets, maintain liquidity, automate everything. The people who followed these principles through every crisis ended up wealthier than those who tried to be clever. 2026 is not different. The specifics change. The principles don't. Or maybe you're thinking, I'm already behind. I'm 50 years old and I haven't been doing this. Is it too late? It's not too late. It's later than it could have been, but it's earlier than tomorrow. Start now. The principles work at any age. They just produce different amounts depending on how long you apply them. The real objection, the one you might not be saying out loud, is this. Can I really trust this? Can I really just follow these simple principles and be okay? Here's what I know. My grandfather followed these principles through a world war, currency collapse, and rebuilding from nothing. twice. I followed these principles through 5 market crashes. Every wealthy family I've ever worked with follows some version of these principles. They work, not perfectly, not without stress, not without setbacks, but they work better than anything else I've seen in 40 years of managing money. Here's what I want you to do. First, calculate your gap, the exact difference between your income and spending. Find ways to increase that gap by at least 10% immediately. Cut subscriptions you don't use. Reduce housing or transportation costs if possible. Every dollar you free up becomes fuel for protection and growth. Second, open investment accounts if you haven't already. In America, maximize your 401k, especially if you get employer matching. Open and fund a Roth IRA. In Britain, use your full ISA allowance. Whatever the tax-advantaged vehicle is in your country, use it. Third, choose low-cost index funds, an S&P 500 fund, a total stock market fund, a global equity fund. Keep it simple. Complexity is the enemy of execution. Fourth, set up automatic transfers so money moves to investments immediately after every paycheck. Remove yourself from the decision. Let the system do what you designed it to do. Fifth, maintain your emergency fund. 6 months of expenses in accessible savings. Replenish it immediately if you ever need to use it. In the comments, tell me, which of these 4 components is your weakest? The gap, ownership, liquidity, automation? I want to know where you're struggling. If this gave you clarity about how to protect your money through whatever 2026 brings, subscribe. Next week, I'm going to teach you the specific mistakes that destroy wealth during economic downturns, the panic decisions that cost people decades of progress, and how to make sure you never make them. Remember, the principles that protected wealth through every crisis in modern history are the same principles that will protect your wealth through this one. Not because I say so, because history says so, because mathematics says so. Shalom, and may your wealth grow as your wisdom does. But before you go, I need to tell you about the mistake that destroys everything I just taught you. The mistake that makes the gap irrelevant, makes ownership worthless, makes liquidity pointless, makes automation useless. The mistake is interference. Everything I've shared works because it compounds over time, but compounding only works if you don't interrupt it. Every time you interfere, you break the chain. And breaking the chain has consequences you can't see until it's too late. I've watched this pattern destroy wealth for 40 years. Someone implements these principles. They start building. 5 years in, they're making progress. The system is working. Then something happens. A market crash, a recession, a scary headline, a friend who says they should do something different, a guru who promises better returns somewhere else, and they interfere. And they sell their investments. They stop their automatic transfers. They raid their emergency fund for an opportunity. They break the system because they lost faith in it for a moment. That moment of interference costs them years, sometimes decades, because they don't just lose the money, they lose all the time that money would have been compounding. My grandfather had a saying, "The fortress only works if you stay inside it." The moment you run out into the battle, you've lost its protection. When 2026 brings scary headlines, and it will, stay inside the fortress. When the market drops 20%, and it might, stay inside the fortress. When someone tells you about an amazing opportunity that requires you to abandon these principles, stay inside the fortress. The storm always passes. The people who stay inside emerge wealthier. The people who panic and run get destroyed. One more thing. The system I've described isn't glamorous. It won't make you rich next month. It won't give you stories to tell at parties. Nobody gets excited about automatic transfers to index funds. But 40 years from now, when you're wealthy and secure while others your age are still worried about money, you'll understand. Boring works. Consistent works. Principles work. The people who got rich quick mostly got poor quick, too. The people who got rich slowly stayed rich forever. I know which one I'd choose, and now you do, too. Now go, build your system. automate it, and face whatever 2026 brings with the confidence that your money is as protected as it can possibly be. That's how fortunes survive. I'll see you next week.